You said something very interesting that I think people are really going to lean into. Infinite Banking 1.0, 2.0, and 3.0.
I want everyone's ears to perk up hearing this. The number one reason that you should be taking policy loans is to, when someone says, well, I want IUL because it gives me flexibility, I know clearly they haven't watched my videos and they don't understand a properly structured whole life policy.
You're like, oh boy, like this talking point again.
Don't ever get an IUL or VUL if you're serious about infinite banking.
Insurance is not an investment. And that's one of the reasons why R. Nelson Nash himself was just like, do not do this product.
But Caleb, I'm going to take it one step further. I tell my clients it's a guarantee. Can you buy cars? Can you pay off debt? Yes, you can. I'm debunking that myth all the time.
People that hate life insurance don't like me. And then the people that like life insurance, some of them don't like me. The math has got to work. If that is a principled decision, go for it. What I don't love is when people try to use half-truths. Barry, welcome to the Better Well Show.
Thank you, Caleb.
I have learned so much from you indirectly. For those of you that know my story, I've have been in this for 8+ years. When I first got in, I looked for people that I could learn from. And while I didn't reach out to you directly, there were people that I would watch their videos on the internet and read their blogs. And for those of you that don't know who you are, you're a part of insuranceandestates.com. You have written a phenomenal book. You've have many great YouTube videos. And again, I'm just grateful that you're on. We're going to talk about whole life insurance, infinite banking. You even talk about your book as like Infinite Banking 3.0, which is going to resonate with a lot of our audience because most of the people that watch this show know of life insurance, might know of the benefits, but are looking and are really researching, how can I take this to the next level? And I can't think of a better person to bring on to chat about all this and more than you. And so I thought it would be great for you to just share a little bit of your backstory. Like, how did you get into this space? I always joke that people don't come out of the womb saying, I want to sell life insurance. I want to write a book on life insurance. It's pretty lame if you think about it. And yet we have this common bond around understanding the power of this asset and helping people around the country set it up. And so with that, thanks for coming on the show. And I look forward to learning and jamming with you.
Yeah, awesome. Thank you, Caleb. So a little backstory, 25 years ago, this was 2001. I was teaching guitar at a university. That's my background. I've got a degree in music, got a couple albums out there, and my summers would slow down. And I had a friend that was a financial advisor. He said, hey, why don't you come get licensed and get in the business, start putting people's money into investments and life insurance. And what was great about that is as a kid, I had seen my parents invest in real estate. They were flipping homes, building spec homes, selling land, all this. And so I thought, someday I'm going to be an investor. It was cool to me. I wanted that in my portfolio as a real estate investor. So when he said, hey, come help me in the world of financial planning, financial advising, I was all in. So I got licensed. I started putting my money and my clients' money into the market, mutual funds, IRAs, and this life insurance product called VUL, Variable Universal Life. And he would tell me, hey, your clients are going to earn 12 to 18% returns. And he would project these, amazing numbers, for 10, 30 years. And it was just pie in the sky, amazing, incredible growth. And I was doing that for about a year or two. And I'd get calls from clients and they would say, Barry, I'm not making the 12 to 18% returns. And then when it got really scary is when clients would call and say, I'm losing money.
Which if I'm doing my math correct, this is right around the .com bubble.
That's right. 2001. Yeah.
So you're getting people set up in financial products, investments, VUL, and then looks really great on paper. But if the investment doesn't work out so well, it's not such a hot product.
Yeah. And I'm losing sleep at night because my clients are calling me with these questions. I'm so new in the business. I go back to my mentor and I say, what do I tell my clients? And I'm hoping, okay, there's an answer here. There's something we can do. And what he told me was the same answer over and over again, Caleb. He said, tell your clients they're in it for the long haul. And I thought, no, this isn't it. That's just crossing your fingers. We're not really helping them in that regard. And it just went against my grain. And it was that experience that forced me and propelled me to find something better. I wanted something that wasn't volatile, that wasn't, concerning people losing money. And that's when I discovered high cash value insurance, but then coupling that with what I've done now for 17 years, which is real estate investing and, other investments as well. But that experience gave me a foundation to say, I can really help people now. And what I do, it's guaranteed 100% of the time. I've never in the last, 2 decades had someone come to me and say, Barry, why am I losing money? That just doesn't happen in the world that I play in.
You just wrote a book called Live Rich, Die Rich, and I would imagine that's around life insurance and then utilizing that life insurance to potentially buy real estate. Is that what you write about in this book?
Yeah, that is definitely an aspect of it. But I start in the book talking about what is wealth. Wealth is not just money. We know a lot of wealthy people out there that are miserable. Wealth to me is holistic. It's you're wealthy spiritually, you're wealthy physically, you're wealthy mentally, you're wealthy in your relationships, and then obviously you're wealthy with your finances. And it doesn't mean you have to have 10, 20, 30, 50 plus $1 million. We can be wealthy with, less than that. But taking that perspective, taking that idea of abundance in all areas of your life, that's really what drove me to write the book. And someone might say, well, I want to live rich, but why would I want to die rich? We learned that dying rich allows a person to leave a legacy. And I've talked to lots of grandmas and grandpas out there, and even parents that say, I may not want to give my kids everything, but I want to leave them something. But what I want to leave them more are correct financial principles. And that's what the book is about. I tell a lot of fun stories, teaching correct financial principles, how to live rich and die rich, but enjoy your life along the way. That's really important. We want to be happy, we want to be abundant, and we want to enjoy life along the way.
Yeah, I've given examples before, like in talks around, Warren Buffett, and you show the picture, and he's known as being one of the wealthiest people on paper, and yet I ask people who would trade places with him. Raise your hand if you want to trade places with a 95-year-old man. Very few hands ever get raised. Some people want to be smart and they're like, yeah, I'm gonna take one for the team and have set up generational wealth. But you get the point. It's like that. What that tells you is majority of people value things other than just a bank account because
Yeah,
he's one of the richest people on paper, and yet if you're not willing to trade places with one of the world's quote unquote wealthiest men, that means your definition of wealth is different. And yet on a macro level, we get it. On a micro level, we devalue ourselves every single day. And so love that that's a part of your book. And then the other aspect is if you have a system to actually die rich, that ultimately enhances how you live. Even financially. If I know that I am going to die rich, that gives me options to do certain things that maybe would not be on the table if I didn't have that certainty.
that's right. So in the last 7 months, Caleb, I've had 3 clients pass away. And even before this, I've paid out death benefits. But in the last 7 months, 3 clients have paid away. Now, one was in their 80s. That was kind of expected. But check this out. 2 of those clients were ages 51 and 39. And my 39-year-old client, he was a doctor. And I talked to his wife, like, Barry, I didn't expect my 39-year-old husband to pass away from an aneurysm. And he did. Now, fortunately, he took most of my advice. He had his high cash value whole life policies using infinite banking. He also had some term insurance because he still had young kids at home. Yeah, I mean, it's important to plan accordingly. On the die rich side of the book, I want people to think about traditional financial advice says, don't spend your principal. Take the Monte Carlo 4% rule, live off of the interest. You leave all that money behind to your family, your inheritors. And what I say is, why not spend and enjoy all of your money and then have a permanent death benefit that comes in and replaces all that, and maybe a whole lot more that you paid pennies on the dollar for, and you're able to live rich now and then die rich, leave your family wonderful legacy and those correct financial principles. What a remarkable system, because we're not getting this from Wall Street or financial advisors.
Yeah, it's a tool that can potentially enhance you to get more cash today, have more certainty today while you're alive, and also guarantee that you have more money to pass. And only in a weird world would people call that a scam or a ripoff. It's just like, okay,
Yeah.
and usually it comes down to life insurance being compared to as an investment. So that's my next question. Um, when people look into this, obviously there's many people that have epiphanies. A lot of people watching our channel, like they're learning about this and they're like, this is awesome. Like I get this. One of my biggest things is life insurance gives your dollars more than one job. The more jobs you understand that a life insurance contract does for you, the more you value it as a tool, as an asset. And so that's one of the things that I'm on a mission to do is like, let's educate people more about this contract. Because it just makes you more multidimensional when you think about this. When someone says, Barry, this is a terrible investment, or I can get a better investment outside, how do you answer it? Because I know how I answer it, and I'm sure people are rolling their eyes on the show because they hear how many times I answer it. How do you answer that question when people give you the rate of return thing?
Yeah. I'm telling people, I'm not saying get out of your investments. And if you're making the comparison, it's not a true comparison. But Caleb, I'm going to take it one step further. I tell my clients it's a guaranteed investment. Some people don't like the word investment, but I'm saying this is a guaranteed investment. And think of this question. So, everyone listening out there, what do you have in your portfolio right now that is guaranteed, that's liquid, and tax free? And most of you listening, probably 9 out of 10 out there, are going to say, nothing. I don't have anything that meets that criteria. So people want this. They want guarantees. They want predictability. They want certainty in their life, and everyone wants tax free. So that next question is, well, what are you going to do to have that in your portfolio? So I like thinking about this. It is savings, but it's a guaranteed investment because it's true compound interest. If you're in a stock and you're reinvesting dividends and the stock value goes down, you can lose money, right? We know 401ks, IRAs, they're volatile. Those aren't true compound growth vehicles. The only way to have a true compound growth asset in your portfolio is if you have a guarantee. So I do like the phrase guaranteed investment, but also coupled with the cash value is accessible and it's tax-free if done correctly. We've got to
Yeah,
teach people what that means in a properly structured policy. But I'm not saying to someone, don't invest in the market.
you're right.
I've got market-based accounts. I've got a
So do
Schwab
I.
account. I trade myself. I've got stocks. I've got crypto. I've got real estate. Here's what I don't like. When you hear from a financial advisor, I want diversification. Okay, get this ETF, get this mutual fund, get this stock. Oh, your portfolio is really diversified. No, you're still 100% in the market. True diversification is a mix of different asset classes. It's the gold and silver, maybe oil and gas, real estate, high cash value whole life insurance, cash, crypto, your business, right? Now you're truly diversified if that's what you want. Not everyone wants that true diversification. Some people are like, hey, I'm going to put my eggs in one or two baskets and call it good. But my point is, true diversification isn't what your financial advisor or Wall Street's telling you, and you go buy more mutual funds or
Yeah.
ETFs.
Yeah, different mutual funds. You're not, yeah, magically diversified. Also, there's a tax diversification as well. Is you can be super diversified, but also looking at it from a tax perspective. So many things that I want to say, Barry. I think it's semantics when you call it a guaranteed investment. It's hard for me to say even those words. Don't sue us. We're not giving investment advice. Obviously, insurance is not an investment. And so if you're a regulator, don't send me any letters. But yeah, I get what you're saying. And we're in the business of like getting people to think differently. And so obviously that's something that you have to be careful because it's not an investment, but it's like the more you understand about it, the natural next question would be this is better than any investments I'm putting my money in, which again, you said it, not me, but like we get that a lot. Um, I'm curious how you explain whole life. And then my next question after that would be IUL and VUL. Would love for you to like explain why insurance, because it's important to me that people understand how the sausage is made. So why life insurance, and then why is whole life different than IUL or VUL? Because I just interviewed someone recently that in a sense looked down on me because we did primarily whole life, and they almost think it's like, oh, only if you knew it, only if you were enlightened, Caleb, you would use this thing that would magically got you more flexibility, greater rates of return. And it's like, listen, if Barry and I believe that IUL is God's gift, like it's a lot easier to sell, and in a lot of cases it pays a lot more. So like
Yeah.
trust me, it's like I would love to be convinced otherwise. But I just like, because of my beliefs around insurance, I'm like, man, I sleep better at night, doing majority. There's caveats to everything. There's some people
Sure.
that do have IULs, guaranteed universal life, but for the most part, what we're talking about is whole life. So with that, explain your definition of insurance, and then talk about the difference between whole life, IUL, and VUL.
I love the questions. Okay. 'Cause again, I'm so passionate about this. And I'm always going to go back to someone's goals. What might be right for person A may not be right for person B. So, what are they trying to accomplish? But in traditional whole life, you're purchasing a death benefit. But in a properly structured whole life policy designed for IBC, we're looking at minimizing death benefit and maximizing cash value so that 70, 80, 90 plus percent of that person's premium is going to cash value. Then they can take loans to make other investments in real estate or their business or crypto, or buy a car if they want to, right? They can do whatever they want with the policy. They are getting a death benefit, and usually that benefit is growing along the way. But life insurance provides benefits. So if at the end of the day, someone said to me, hey, I want guarantees, I want access to cash, I want tax free use of my money, I want a permanent death benefit that's never going to go away, I want asset protection depending on the state I live in, I want legacy planning, estate planning, Caleb, there is nothing better out there, hands down, than cash value whole life insurance. And it's a tool of the wealthy. I think about this often, the wealthy leverage assets. Well, this is an asset. It's an asset that you never have to worry about. You're never going to lose money, right? If you follow what we teach you, you're going to have this tax free bucket of money now. And your retirement, maybe you've got a 401k, maybe you've got an IRA or a brokerage account. This can turn into a stream of tax free retirement income when you're ready to start taking that money at a later date. So it is life insurance, but don't think about it as just life insurance. Think
Yeah.
about the benefits that you're getting. That's the most important thing. What do you want? What do you want your money to do? And in my 25 plus years, I've not seen anything better when someone's wanting all those benefits than cash value whole life. And then we'll get to the second part of your question with IUL and VUL when you're ready.
Yeah, I'm ready. I could not agree more with what you said. I appreciate the other benefits that you shared. I originally, when I got into space, my original book was the and asset, and the
Oh, yeah.
epiphany was you can have your dollars doing growing, and you can utilize it. So I was obsessed early on, and a lot of people when they get into the infinite banking space are like around having your dollars doing two things, growing and using, which again is really powerful. More I learn about this is if it was just those two, you could make a really good mathematical argument that life insurance may or may not be the right thing for you because you're really not getting arbitrage. You're not getting your cash value is not necessarily growing at a higher rate than the borrowing rate, which by definition means mathematically it's not smart. If you're only earning 4.5, 5% and it costs you 6%, math would tell you you're not a genius. But then, but the more you learn about all the other benefits that you mentioned, creditor protection, the death benefit, the living benefits that you get with the death benefit, now when you add in the tax benefits that you get and all these other aspects, then you go, oh, I'm not saying life insurance gets you 9 to 12%, but when you start factoring in all these other benefits, you could you potentially would need to earn 9 to 12% just to get all the benefits you're getting with life insurance. And so by definition, it actually does give you arbitrage if you're looking at beneficial arbitrage. And if I were to talk to someone and say, hey, you can put your money in this account and it's going to pay you 10% and it costs you 6% to access, you would put as much money as you possibly could into that system. And so while life insurance doesn't necessarily give you 10%, if you understand all the benefits to that, that's so like that was my recent epiphany, like as of the last year or so. I'm like, we need to get louder when it comes to that because I hope it resonates with more people. Appreciate you mentioning that. Is there anything you want to say before we go into IUL and VUL?
So I've done a lot of videos out there, not talking about the other benefits and just looking at the numbers of market volatility, cost of term insurance,
Yes.
and then the taxes. And someone would have to earn 7 to 9, maybe 9.5% every year just to net down what they're earning in a cash value policy. Then you add the benefits on top of that. Now we are talking 10, 11, 12%. But think about that. If you could get an effective 7 to 9% rate of return, no market risk, no loss of sleep at night, predictability, peace of mind. I mean, Caleb, this is huge. And that's one of the things I talk about in the book is like peace of mind. If you've got a financial hardship, it affects everything else in your life, your mental state, your emotional state, your health, your relationships, right? Imagine having this in your portfolio, like, oh, I'm home free. The
Yeah.
market's down. My cash value whole life policy made money this year. Or the economy's in a turmoil. Oh, my cash value whole life policy made money this year. And that's what happens. I've seen this now for over 2 decades. You make money every year. So I want people to understand effectively, yeah, it's a 7 to 9%
Yeah.
rate of return.
I also without I don't want you to share any personal info that you don't want to, but how long has been your oldest whole life policy that you have?
Well, so back in the day of 2001, I started my own VUL.
Okay, okay. You still have it today?
No, it blew up.
Okay, oh no. Okay. It's a great marketing message, but it stinks for you. Do you have but you when it comes to whole life, what's been your longest whole life policy you've had?
Uh, so probably 12 to 15 years. I'd have to go back and look at the
Okay.
date. Had term insurance before that, so 12 to 15 years in
So here's
my
my
policy.
question is and you don't have to share the contribution, but like let's say you put in $10,000 a year into your original whole life. It's what's the cash increase percentage? Do you know that? Like it because that's where it gets almost dumb, where you're just like,
It's
why would
dumb.
you stop funding money into a policy when you're able to
That's
put a dollar
doubling.
in?
Right. Right. So 10 years, 12 years, you put in 10 grand and it's growing 18 to 20 to 22,000. Why would you stop doing that? And
Yeah.
that's what my policies are doing.
Well, okay. So now let's talk about IUL and VUL and what a lot of people will say is, Barry, you're in the Stone Age. Come on, we can get you a higher return. Yeah, it's a little bit less guarantees. It's so funny. It's like the core thing that you and I are talking about is like solid foundation. Well, let's just not care as much about the guarantees and let's like get the upside. And what I always say is like, if you're gonna get the upside, just invest. Don't try to do it through an insurance wrapper. Want to hear the how you explain IUL, VUL, some of the things to watch out for because there's certain people in the city that you're in who are talking about IULs and then even IUL's boring. You got to leverage within the IUL and you're just looking like a genius.
Yeah. Three major problems. And again, I've done a lot of content on this. I'll address them quickly. Number one, most IULs, not all, have surrender charges. So if you put 10 grand into a policy in an IUL or a VUL, you might have access to $1,000 or $2,000. There are some that you might have access to more, but those surrender charges, and Caleb, I've analyzed hundreds, I mean, 25 years, hundreds and hundreds of IUL and VUL illustrations. And in the videos that I've done, I go through real illustrations. I'm not leaving anything to chance. I'm showing people these companies and these bad IULs. So surrender charges can last 10, 12, 15 years, which means you don't have access to all your money. Don't ever get an IUL or VUL if you're serious about infinite banking. because you just don't have access to much money. Number two would be the increasing insurance costs. IUL is built on the chassis of annual renewable term insurance. What that means in its simplest form is as a person gets older, especially in their 50s, 60s, 70s, 80s, the cost of that insurance is going up. If you look at the guaranteed columns of an IUL or VUL, most of them will show the guaranteed values and even the alternate values. The cash is going down. And people are saying, well, why is my cash going down? Why did my policy on paper show that it's lapsing at age 62? Like, yeah, because of the increasing insurance costs. And if you don't pay more premium to support that increase in cost, what does the insurance company do? They steal or rob your cash value to pay the higher premiums. And I bet your agent, if you have an IUL, either didn't tell you that or doesn't know
Yeah.
that.
Yep.
Problem number three, I describe this as unrealistic returns. When you look at an IUL illustration or VUL illustration, dude, they look sexy. They look amazing. And they look amazing because it only shows a person making money every single year. So here's my question that I'll ask someone looking at an IUL. I'll say, do you believe that you're going to have a positive 6 or 6.5% rate of return every single year in your policy and never have a losing year? That's my question. And what do people say? Well, no, that's not how the market works. But guess what? That's exactly what's shown on your IUL illustration. So unrealistic returns in the illustration are showing people you never lose money. We know that isn't true. There might be a floor of zero, but the illustrations don't account for that. It only shows a person making money. That's a problem, but man, they look amazing. So I don't want anyone to deal with surrender charges, increasing insurance costs, unrealistic returns. None of those problems are in a whole life contract. And there's like 7 other problems we could get into, but
Yeah, those are the big
those
ones.
are the top 3.
Yeah, I think obviously, like, there's caveats and exceptions to the rule, and so there are people that are doing IULs probably well, especially if it's monitored rightly. There could be estate reasons why it gives you a little bit more flexibility. So, like, with all that, like, there's that caveat, but the whole idea is then it really is acting more like an investment. And then we're going to talk about infinite banking in a second. If you're going to do something like that, you almost have to be more okay with saying, you know what, this idea of infinite banking creates a lot more risk to an IUL product than a whole life. And that's one of the reasons why R. Nelson Nash himself was just like, do not do this product. Like, do not do this product. That was one of the reasons. The other big issue that I have is many times the people that are selling these type of products aren't going to be in the space to service them. So number one, they're actually not educated. So like at our event, we have people that work at family offices, and we can have like dialogues around IUL versus whole life, and usually the conversations go really well and interesting. But the pushback I would give to that is like, okay, you have a family office, and that you just told me that you have a whole team that monitors these things. What about the person that doesn't have the family office? What about the person that's doing an MLM company? What about the agent who statistically is not going to be around 3 years from now? That's the issue. And by the way, it's the same problem with whole life. The difference is whole life is not just going to magically blow up on you. And the
That's right.
second thing is whole life's a lot less sexy to sell. And so technically it's not across the board. Trust me, there's plenty of bad examples. We see it almost every day in whole life. So that doesn't get a pass. But it's just, if you're going to go an uneducated route and make a quick buck, it's 10 times easier to do it on an IUL illustration than a whole life. Anything you want to add to that around, like, maybe you disagree, feel free to push back. I do want to acknowledge that IUL, there can be a play, but not in the infinite banking space. And that's one of the reasons why at least I take a stand. And it sounds like you take a stand as well.
I do take a stand, and I like to share with clients, if you want the guarantees, if you want the fle flexibility, if you want, the things that the IUL offers, here's what I'll tell you. because flexibility is a big part of an IUL, but people are hearing that they can't get flexibility in whole life insurance. That isn't true. I was looking at a $150,000 premium this morning with one of my clients. He's in underwriting. His $150,000 premium, he could keep funding that for 2 years, 5 years, 7 years. But guess what? His minimum premium on that policy is about 8 grand a year.
Yeah.
So talk about flexibility. He can keep going up to 150 a year, all the way down to 8 grand or any amount in between. That's the same flexibility that an IUL has. So when someone says, well, I want IUL because it gives me flexibility, I know clearly they haven't watched my videos and they don't understand a properly structured whole life policy, because people will hammer whole life,
Yep.
no flexibility, not in the types of policies that we offer.
Yeah, all the talking points, and it's at this point, it's like I want to react to like a 2.0 criticism of life insurance, because it's like no flexibility. They keep your cash value when you die. You're like, oh boy, like this talking point again. It's terrible growth, no cash value in the first couple of years, and I'm like, actually, if those were all true, I would be on the same page as them. So it's actually kind of fun because it's like, yeah, that's exactly why we do things different. And I don't know if you get the same. Plenty of insurance people are not my biggest fan because they see the videos that I do, and probably you do, as like exposing them. And so
Yeah.
we joke about this. People that hate life insurance don't like me. And then the people that like life insurance, some of them don't like me because I'm saying certain things in my videos. And so I have like a little group of friends, and I guess that's my destiny.
Caleb, let's help you get more friends.
Yeah, please subscribe. We're trying to get to 100,000 subscribers this year. So if this content has been valuable, just throw me a bone and please subscribe and share something in the comments. If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there. All right, let's talk about infinite banking. And you said something very interesting that I think people are really going to lean into is infinite banking 1.0, 2.0, and 3.0. Before we get to 3.0, which everyone wants to know, there's probably maybe something in the title. I think that's what we're going to title this thing. I want you to define what infinite banking is. What is 101 in your words? What is 201? And then what makes 301 301?
Yeah. So infinite banking is the ability to take a policy loan from your whole life policy and go invest in whatever you want. And usually 1.0 is like, let's go buy a car. But 2.0 then pushes me to say, no, the number one reason, I want everyone's ears to perk up hearing this. The number one reason that you should be taking policy loans is to buy assets, create more wealth in your life. And you're like, Gary, I don't know about real estate. I don't know about crypto. I don't know about owning a business. Go learn. Go learn. What reduces fear in someone's life is education. When you get educated about something, that fear goes away. I'm not going to go perform surgery on someone tomorrow. It'd be very risky for me, and it'd be even more risky for the patient. But the doctor, the surgeon performing the surgery, he's done it 1,000 times. It's not very risky for that surgeon. Is there some inherent risk? Yes, but much, much less risk than had I been doing that surgery. So get educated, learn about it. 3.0 is start thinking about not just investing and creating wealth, but now we're talking also about family. We're talking about legacy. But I also call it 3.0 because in Nelson's original book, Becoming Your Own Banker, and he wrote it a long time ago, right? So I say 3.0 because it's updated now for 2025, 2026. But there were some things in the book people still ask me about today that they felt were confusing. They felt like the dividends or the way that you buy the peas and right, all that. So I went and clarified some of those things, and I'm using real life illustrations. I'm using real life numbers. And this is kind of a fun story on the legacy side. when my daughter, I've got children, and one of my daughters, when she was 15, I asked her what she wanted to do for her 16th birthday. And she said, Dad, I want to go skydiving. And I was like, oh. Said, let me think about this. I'm not going to give you an answer now. And as I thought about it, I thought, oh, I'm financially fine. I've got life insurance, millions in death benefit. And I told her within a few days, let's go skydiving and I'm going to go with you. So we did on her exact
Wow.
16th birthday, Caleb. We went skydiving. And what was so cool is we were kind of Canyonland area in Arizona, Utah, right over the Grand Canyon and Lake Powell. It was unbelievable out of Page, Arizona is where we did that. I've had clients say to me, Barry, I've canceled my ski vacation because my life insurance isn't in place. I went skydiving with my daughter because I had the protection. I had my plan in
Mm,
place. That's 3.0 thinking, right? So that abundant mindset, it's going to take you to a new level.
yeah.
And and it's possible. That's what I want people to know is that it's possible. So number one, buy assets. Can you buy cars? Can you pay off debt? Yes, you can. But to create and grow more wealth, run those investments, run those opportunities through your policy. That way, like Caleb said, that and asset is doing more for you. You're creating wealth and you're making money in multiple places at the same time.
So 1.0 is using a life insurance policy to buy things like cars, vacations, maybe paying off
Debt,
debt,
pay off debt. Yeah.
kind of deal. The 2.0 is using your life insurance policy as an opportunity fund to look at deals. Got some questions there. And then the 3.0 is to do that, but then really have the legacy mindset and you can do more than one thing. Like you can be buying assets, but you can also set up your financial life to be able to have a ripple effect. Did I summarize the 1, 2, and 3.0?
Yes. That
Okay.
that's a very good summary.
There are people on the internet, and I've had them on my show. I've had debates with them and all that are they very much use cars as the example because that's the gateway that gets lots of people excited. You can buy a car, and I don't know if you saw one of my recent conversations I had with Chris Noggle where we're actually debating around like life insurance, buying cars, and I even said like I said this I was like the goal, and I believe Nelson's in his book. Let me preface: Nelson had a principle of not doing business with banks. I appreciate that, and if someone has that, it's like game over. There's nothing that needs to be said. It's like if that's going to be you, if you're not going to do business with banks, then use life insurance for everything, or do business without banks. It doesn't math doesn't matter at that point. So I just want to be clear, if that is a principled decision, go for it. But what I don't love is when people try to use half truths and they're like, hey, and I'm not necessarily calling any one person out, but they're like, hey, this is what you should do. And you're like, actually, what you're telling me is not aligning with what's actually true. And when it comes to infinite banking with cars, the I want to get your thoughts on this because I've always said is if you can get a car loan at the same rate or lower, you would be better off taking the car loan and then paying the difference in extra PUAs if you really wanted, and you would actually have more money than if you took a bank like took a policy loan kind of deal. I want to get your thoughts there. If you disagree, let's push back. If you agree, let's talk about it. And then I want to ask another thing when it comes to cars before we get into assets.
Yeah, what I tell clients, I agree 90% with what you just said. If the loan rate is the same, I will probably steer them towards a policy loan. But if the car loan rate is under the policy loan rate, financially, it makes more sense to borrow money from the bank from the auto dealer, right? The last one of the last cars I bought was a Cadillac. I got 0% financing. Why would I take a policy
Right.
loan to go
And you
pay
could
off
even be
that
an honest
car when I'm
banker if
getting
you wanted, and your your
yeah,
your cash value would increase more because you'd just be paying in new premiums.
yeah, so I like the idea of taking that extra little money and putting it into PUAs, but I always tell clients, I'm gonna come at it with the perspective of financial numbers. I'm not gonna get emotional about it.
Right.
If something makes you sleep better at night, you want to pay off your house and it makes you sleep better, okay. But I'm going to talk to you and come to you only based on financial numbers. So if your policy loan is 6% and you can go get the car loan at 3%, do not take a policy loan to go buy that car. It just financially, that doesn't make
Okay.
sense.
So now I'm going to go 2.0 within the 1.0. So let me know if you're still following on YouTube. Okay. So, okay. I'm with you. Totally agree. Now let's say my policy loan is 6% and let's say the car loan's 8%. I'm still going to take the car loan. Here's why. Is I value liquidity and control of my money because we just talked about 2.0 of buying assets. I would much rather pay a premium to something like banks will lend you money on primary residence and they'll lend you money on cars. They won't necessarily lend you money on an investment idea or a business. And so this is where it's like it's not for everybody because some people are not entrepreneurial at all. Some people they have to value their opportunity cost or the control cost. What do you I'm just curious your take because you even mentioned if it's the same or if there's different, you're going to tell them to take the policy. I'm curious, what are your thoughts on that take? Because I know that that's maybe not the most popular take. Just for the record, both of my cars that I have are paid off. I don't do car loans. Like I just live below my means, so maybe that's like the secret. So what I'm not endorsing is go out and get loans because I think getting loans can just enable bad decisions. All I'm saying is if I was going to get a new car, which I eventually need a new car, and let's say it's a $50,000 car, I'm gonna take a loan if I'm given a somewhat competitive loan, even if it's higher than my life insurance, because I value control and liquidity. What's your take on that? Do you think that's a slippery slope? I would love in real time. I love talking to people that are like know this space, have tons of clients that do this for like run the math. Like I'm just curious your take on that.
Yep. I had said something earlier about some goals, right? So I'm gonna look at that. But I'm also gonna look at a person's personality. Are they just a W-2 employee, which is fine? Are they non-entrepreneurial? Are they not making other investments? That person, it's probably going to be better to take the lower loan rate from the dealership. But now get with someone that says, hey, I'm ready to invest in real estate, or I've got a crypto portfolio, or I'm going to start another business. They are entrepreneurial. They need their cash to put it to work. And they're like, hey, the next investment I do, it's going to provide me double-digit returns. Well, then, yes, by all means, keep the liquidity as you're talking about, pay the 8% with the
Okay.
bank or the dealership. So I'm in agreement with you, but I always look at this on someone's individual goals and
Yeah,
what they want to accomplish. Most people are going to say, well, I want the lower loan rate. They're not as aggressive
I
on
agree.
opportunities or whatever the case might be. But liquidity is huge, right?
Yeah,
Having cash allows you to take advantage of those opportunities.
yeah. I was just about to say, paying off your house aggressively. Dave Ramsey would say that's the best thing you can do from a risk standpoint, and I get like my heart starts pumping faster,
Yeah.
and I would feel less. It's funny. I'm going to tell you something that I haven't told anyone. I'm in the process of getting Dave Ramsey a gift because he's in my backyard, and I'm writing him a letter on just like how like I really would love to interview him this year. It would be a huge for me, and I would do it respectfully and all. And one of the questions that I ask him is the house deal because I'm just like respectfully, I I don't wanna pay off my house, not even from the mathematical standpoint, from the risk standpoint, and I'm just curious because that's always the playing card with paying off your house. Yeah, mathematically may not make sense, but you'll just feel you're safer, and I'd be like I'm the kid in the back of that. I'm like, "I don't know if it's as safe as we think it is." I actually think it feels more risky, and so that I am, the likelihood of him agreeing to do an interview with me is almost 0, but you know, I would love to get his thoughts and dialogue on that because it's like if you don't think much about it, you would think paying off house is the safer move. But you could say like putting your money in a high yield savings account or newsflash and a high cash value life insurance, keeping the cash equivalent. So you're still having the same amount of money, but I would actually pay a premium, 1 to 2% premium to have access to cash versus a paid off house. And the bank is now in control of Are they going to give me that HELOC? Are they going to close that HELOC? Do I need to sell to get that money? Like, man, I sleep way better at night knowing that I have 20 years, 30 years of mortgage payments in this bucket and optionality versus a house but no money.
Yeah, how do you tap into equity if there's not a way to do it? If the bank rates are too high, you can't get a HELOC, maybe your credit has suffered. Like untapped equity,
Yeah.
so many people are dealing with this in the world today, especially in the US. If you can't tap into equity, you're not really growing your wealth like you should be.
Yeah.
Uh, Debt is a good thing. When you're using debt constructively and productively, debt is amazing. And I would ask the question, why do these Fortune 500 companies have millions or billions of dollars worth of debt? Because they're using debt to their advantage. They're using debt to grow their companies. The other thing that is risky is, and I've done these videos, 15-year mortgage versus 30-year mortgage, etc. If you get into a financial hardship and you've got two neighbors, right, side by side, one's got a home with a 15-year mortgage and the other one's got a home with a 30-year mortgage, the bank is going to go after the 15-year mortgage person first because there's more equity.
Yep.
So there is a risk there. Now, with all that said, if your spouse is saying to you, I'm just going to sleep better at night, I'm going to be a better spouse, a better mother, a better father. If our home is paid off, I'm going to have peace of mind. Well, then by all means, you better
Yep.
consider
That trumps.
that. Right? But there are some risks to untapped equity, and there are some risks if there's a financial hardship. And there's some other things we could talk about too. We want to put that money to work. So I'm with you.
Yeah.
I'm not paying off my
Totally.
mortgage early.
You
I
you're
want to
you're
use the cash.
you're totally right, and you're totally right. If something helps you sleep better at night, even if it's a placebo effect, do it. Don't try to have anyone talk you out of it. And I always cringe sometimes because it's like I want people to like understand. Like I want them to do the right thing. I want them to do the right, most efficient thing. But I totally get it. It's like if you got to do it, you sleep well at night. And I also think when you're thinking about debt, there's a lot of people that get in trouble with debt is because they're and it's enabling them to buy things that they can't afford or like take on
Yeah.
risks that they shouldn't take versus like you're going to do the same exact decision. Actually, if you're going to do the same exact decision, getting debt actually reduces your risk because it gives you more options. But that's like a 2.0 debt conversation because the average person, debt is debt. It's just all kind of like that, the same bucket. And actually, debt, there's two types of debt. And I actually am very much in the Dave Ramsey camp. I don't have any debt on the business. I'm personally, debt is not an enabler for me to be in somewhere that I can't afford, and so like, and I don't take on debt to like try to earn an extra buck. So like on this side, I'm very very conservative, but then I'm also like I'm with you. It's like if I could get a I mean, I would even be open if I could get a refinance my cars right now, my paid off cars. Like I would be open to that conversation because it's like, well, it's just a math. It's like, is this gonna give me more? Like, what's gonna better the Guilliams household?
And
There's a
and
lot
if
more
you
for us
had
to
an
cover.
opportunity,
Yeah,
yeah, if you saw an opportunity and you need cash, by all means, go refinance it 3, 4, 5% and get your double digit returns
that's
elsewhere in
right.
those other investments. That makes sense.
So two things. People are really interested in systems around 2.0, 3.0. Do you have any systems of tracking loans, assets, how money flows? Talk to me about your system of actually funding policies. How do you determine what policy you use when you make an investment? How are you flowing money back? I'll let you talk on that. Very curious to hear in someone that's been doing this 10 plus years, how you're doing it.
Yeah, and I keep it very simple in an Excel spreadsheet. And everything that I'm teaching clients, Caleb, I want to be simple, right? I want to take complex topics and make them very simple to understand. There are advisors out there that will take a complex topic and just make it more complex. So from the position of policy loans, tracking, keeping it simple, I've got policies with multiple companies, not just one company and multiple policies over the last 15 plus years. I'm looking at, okay, how much cash do I need? What's the loan rate, right? What's the dividend? I'm looking at all those things. But generally, when I'm taking a policy loan, it is because I'm going to cash flow with that money on the other side. So for me, it's just very simple. It's an Excel spreadsheet. I've got the loan. I know what's going on with it. Um,
Okay.
and I'll mention two things. So if I took a loan to go buy crypto, and I had owned crypto before that, but I took a loan to buy crypto, I'm not paying that policy loan off right now. I'm just letting it accrue interest, right? Maybe at the end of the year, I usually recommend I'll pay the interest off so the interest doesn't get added to the loan. But I've also got loans out there for real estate. I'm a real estate investor the last 17 years. Those real estate loans, I do set up an automatic monthly payment back to the loan. Why? Because I'm getting monthly cash flow
Yeah,
from my real estate rentals. So that just makes sense. So because you can pay back loans however you want, I look at where am I invested and how do I want that system to flow
I see.
based on that particular loan.
And I'm assuming you're using direct policy loans, or do you use a third party lender to
Direct policy loans.
is there a reason you do that versus a third party?
Uh, just logistics and time. I've never taken the time to go out and
Okay.
get with a third party. And like I've got a loan right now, it's 4.85%. I don't
Yeah.
know that I could get that from a
Take
lender. I've
that
got
all day
another loan
long.
at like 5% or 5.3%. So maybe if loan rates with banks came down to 1 or 2%, I'd consider it. But just frankly, logistically, my time,
Yeah.
my bandwidth, I just have not done it.
Cool. Cool. Love everything that you mentioned. And yeah, the cool thing is flexibility. That's one thing that gets people in trouble because they have optionality to decide, which a lot of people don't make great decisions, and so that's just the nature that comes with it. But having more options by definition should give you better outcomes. Um,
And one of the things I want to address that you said earlier, I still use banks. Okay, when I buy real estate, in most cases, I'm taking a policy loan for the down payment. Then I'll get bank financing for the difference. Can there be or will there be an opportunity where I take a policy loan for all
yeah.
cash and then I go do a refinance? Maybe, but I still use banks because I want to leverage OPM,
Yes.
right? Other people's money. And if I can do that for maybe a lower rate, 30-year amortization, a lower payment, more cash flow, we want cash flow. We want to create wealth. So I still do use banks and my policies in combination.
How do you do due diligence for the 2.0 versus and 3.0? Because it's like Robert Kiyosaki wrote this amazing book, and you could almost read that and be like, okay, just put your money in real estate. And there's so many people that lose money in real estate every year
Yeah.
because they just don't know what they're doing. Most businesses fail. Alternative investments, there's been Ponzi schemes out there. So I'm just wondering, like, how do you vet deals? And I'm sure you've made mistakes. Most people have. What have you learned from the mistakes you've made? And what would you say to the person that is literally funding money into a life insurance policy, seeing it as an opportunity fund to invest? What would you share with them to help them maybe save a lot of heartache and money?
Yeah. And let me share in 2008, 2009, the market crashed. I was living in Las Vegas at the time. It was the hardest hit foreclosure market in the entire country. And I lost over $1.4 million. It was brutal. It was difficult, but it taught me a lot. So when I'm vetting deals, I try first off to stay local. I want the education. I understand the education locally. It's in my backyard. It's in my wheelhouse. So if someone's looking at getting into real estate, I tell them two things. One, start local, or two, look at a turnkey real estate company that's doing everything for you. They're taking care of the lease, they're taking care of the tenants, they're taking care of all the maintenance. You send the money, they send you a check. Now, you do have to vet those companies and you do have to vet those deals. You're looking at the performance, you're looking at ROI, you're looking at cash on cash returns, all those things come into play. And I've done some real estate videos if people want to like look at definitions and what they should be looking for. Those are the two main things I'm telling people. Once you have that education and you feel like, okay, I'm a real estate investor, then begin looking elsewhere. But
Cool.
you're right, Caleb. You can lose money in real estate, and people do lose money in real
Yeah.
estate. It's not as sexy as it sounds initially. It takes work.
Yeah.
What I said earlier, it takes education. Education is going to mitigate and lower that risk.
Yeah. I feel like investor 1.0 is learning about the power of compounding. That's it. And then investor 2.0 is like understanding the power of compounding, but acknowledging due diligence and risk. And like 3.0 is everything's based around risk. Preserve principal and try to get market rates of return with lowering risk. So it's like the 1.0 and maybe 2.0 are trying to maximize returns, and I find that, like, the people I really admire that are doing big things, they're trying to get market returns by lowering their risk. And I think if you can think that way and you can set up a foundation with life insurance and you can invest that way, I mean, you're creating a massive legacy, lots of efficiency, and it's I mean, that would be an incredible thing if you can compound over 20, 30 years, and yet most people have a couple resets because, they're maybe not taking due diligence as much as they're maybe not as passionate as due diligence as maybe they should be.
Yeah, and I was over leveraged. I mean, frankly, in 2006, 2007, 2008, I was over leveraged. I just thought there was never gonna be a bubble. Las Vegas was growing, it was an
Yeah,
amazing place. Then foreclosures happened and it got really crazy. But again, learning a lot from that experience helped me propel forward. Took me a few years to get out of that mess, but it taught me a ton.
yeah,
I don't wanna change the experience, and I can't, but I learned from it. I now leverage that experience today to say, "Okay, I'm gonna be smarter, more due diligence, make better decisions based on that experience," and then I can teach that to my clients. And
love it.
I've vetted a lot of deals, and clients will bring stuff to me and say, "Hey, I need a second opinion on this." So, I'm grateful to have that experience and have the knowledge and then
Yeah.
share it with other people to help them.
Barry, thank you so much for coming on. We will definitely put the link in your book down below. I'm curious, what was like the anything about your book that we've not talked about that you're like, hey, this is a funny story? Obviously, people should get the book, but for the people that are watching, listening right now, is there something that you wrote about? Is there a story? Is there like an insight that sometimes writing helps clarify things even more? And I'm sure you probably had multiple re-epiphanies as you're writing this. Anything that you would like to share with our audience before we end today?
This is funny. So I love to mountain bike. I'm close to amazing mountain biking trails here in Arizona where I live. And one day I'm driving my truck back with my mountain bike in the back of the car. And I see off to the side of the road, and this is in the wilderness, right? Off to the road, it's beautiful. There's a river running on the other side and mountains on one side. There's this red Target shopping cart out in the middle of nowhere. And I'm the type of guy that's like, I'm gonna pick it up and I'm gonna take it back to Target, right? Because that's what I do. That's how I live my life. So I pull over, I put the red Target shopping cart in the back of my truck with my mountain bike. And as I'm driving down the road, I start thinking, other people are seeing me with this red Target shopping cart in the back of my truck. I wonder what they're thinking. Are they thinking I stole it? Are they thinking, why does this guy have a red Target shopping cart? The point of telling the story is there are people out there that believe something about whole life insurance or infinite banking that isn't true. There are people thinking about something that they're just looking at. This is what happened. Barry stole the red Target shopping cart. That's not true, right? So I want people to walk away saying, I want these benefits. They're telling me I can get them. They're telling me and helping me to grow wealth. So don't think that the red Target shopping cart has been stolen. Don't think that whole life insurance is all bad as these financial entertainers would have you believe. Much of what you hear, especially about properly structured infinite banking whole life policies, just isn't true. So we want to set the record straight. I tell people all the time, look at your own numbers.
Yeah,
You're concerned, you're worried. Look at your own numbers. When you see your own numbers, it's a light bulb moment. We would
right.
encourage people to
And
look at
we
their own
mentioned
numbers.
many of these, but what other myths out there do you find yourself having to re-explain or fight against?
Oh my gosh, so many, like where to start. The life insurance company keeps my cash value. Well, what the financial entertainers don't talk about in these types of policies is you get a growing death benefit. So if you got a half a million dollars day one and you pass away 30, 40, 50 years later, and that is now a 3, 4, 5, $6 million death benefit, did the insurance company keep your cash value? No. As a matter of fact, if you add up the cash value at the time of death and the original
Yeah,
500,000, guess what?
it's a
The
lot
death
more.
benefit is usually a whole lot more, right?
Yeah,
So I'm debunking that myth all the time. This is also something with infinite banking. You're borrowing your own money. That isn't true.
not
When
true.
you take a policy loan for infinite banking, the life insurance company is giving you their money. They're taking
Yeah.
money out of their general account, giving you a loan. They put a lien against your cash value. But what I love most is they did not physically remove the money from your cash value. You're still earning interest and dividends on your total cash value, even though you have a loan. That's remarkable.
Yeah. Do you mentioned earlier that R. Nelson Nash's book, Becoming Your Own Banker, is great, but it was written a while ago and there's maybe some things that were confusing. I know I had to read it like 3 times before I started to like really understand what was going on. Um, with that, what have been some of the things that you have tried to re-explain or have to try to explain to someone who might be in the same boat around like, "Hey, I read this book. I think there's something here, but I have no clue what's going on," especially as I get to near the end of this book. Uh, I would love to
Yeah.
just hear your take on that.
Yeah. One of them is what I just mentioned. That, you're borrowing your own money. The clarity there is that you're not, and your cash value is still working for you. There is some myth also about direct recognition and non-direct recognition companies, at least in the companies that I use, you still earn interest and dividends on total cash value, whether you're direct or non-direct recognition. And then, another one, it's lost it's lost in my mind here, but I'll try to
I think
remember it.
the biggest one for me is the the actual illustrations are withdrawing money.
Oh, dividends, yeah,
Yeah,
when you said illustrations, it reminded me. The dividends when Nelson wrote the book are much different than
yeah.
dividends today, but anyway, go ahead and finish your
Yeah, no,
thought.
it's just the illustrations, you're literally withdrawing money, which is not happening. You're repaying it, which you can't do if you're withdrawing it. And Nelson did that to be simpler, which maybe was the case 25 years ago. But
Yeah,
nowadays, it's like, okay, um, you almost shouldn't have done any illustrations. Like because it was like the concepts itself. Like when I did a book review, it was it was awesome. Like I reread the book recently, and like the stories and all are so profound, so profound. Some of the things that are still coming true to this day around like taxation and government. But then you get to the illustrations and you go, okay, I hate the fact that I hate the fact that I have to like almost explain it to say like, hey, don't actually look at the illustrations. Like get the concept, but the more you look at it, the less you're gonna actually like the more analytical you are, the less it's gonna make sense. And Nelson tried to just make it simple because I don't know if you had the pleasure of meeting Nelson.
yes, yeah,
He was did not care about every little detail. He cared about the concept. He cared about
yeah,
he was a much bigger thinker than most people thought, and he would even, like, give, like, our mutual friend Todd Langford hard times. He's like, "Don't worry about the math," and, like, you and I love understanding, like, the math has got to work because if I'm gonna say something, it's gotta work this way, and so I think that's important, but I also think some of the math nerds, I would put us in that category, sometimes can miss the big picture. That's why I think it's important for us to be able to share both. But maybe we have you back on and we get into like more the the numbers and the drawings and even the presentation. So know that you have an open invite anytime. If you have a blog, if you have a concept, if you want to like actually show how life insurance and real estate work in a case study, know that you're always welcome to come back on. And very
yeah,
grateful for the work that you do. We'll include your YouTube channel, and we could potentially even do a collaboration where people could see your YouTube channel on here. And I will have a link to your book and any other resources that you want to give me, we can keep in the description. Barry, is there anything else you want to say as we wrap this thing up?
Yeah, well, thank you so much. So the book is available on Amazon. If someone wants a signed copy, I'll send that link. You got a signed copy coming to you, and that link you have. Uh, People have the opportunity for more better things in their life, more better, right? And that starts right here.
That's right.
So we want people to be thinking differently. And look, life is hard at times, don't get me wrong. But your mind and what you're putting in your mind is going to have a result outward. So we want to encourage people, put those good positive things in your mind. Life is amazing. The world is amazing. The news and the media would tell us differently. So be sure that you're filling your mind with those good, positive things, the spiritual, mental, emotional, physical. Take care of yourself. That's really important. And it all gels together.
Yeah. I think Earl Nightingale, The Strangest Secret. What was the quote?
So
You
is the
are what
ask
you think
after the
about.
solution. Yeah.
You are
Yeah.
what you think about, and you become what you think about. I think that was the quote, and it's so true. What you think about ultimately determines more about your life than anything else. And so, with that, Barry, thank you so much for coming on the show. We'll include your book and down below, and very very grateful for you, and excited to see what the future holds. And let's make this year the best year yet.
That's right. Thank you, Caleb. Appreciate all you're doing as well.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video.